All right. Good evening, good morning, good afternoon, everyone, wherever you are. Thank you for being here with us tonight, and welcome to HBS Alumni of London with Brad Feld and Kartik Varma. This is our most popular event to date, so we're very excited about tonight. No need to say that we're absolutely honored to have Brad with us. I'm sure you all know him. Brad is a VC legend, co-founder of the Foundry Group in Boulder, Colorado, Techstars, and before that, Mobius Venture Capital. He's been an early stage investor and entrepreneur since 1987 and wrote quite a number of books. The last one we'll discuss tonight is Evolving an Entrepreneurial Ecosystem, the Startup Community Way. If you've not read it yet, you should definitely do so. And before I hand over to Kartik, HBS MBA 2002 and Managing Director at Techstars in London, a quick housekeeping. We kindly ask everyone to respect our community rules. They're very simple, just be polite and respectful when engaging on the chat or Q&A. And finally, we'll be coming back online on the 10th of November for our pitch event and on the 1st of December to discuss quantum computing. Thank you all again. Kartik, over to you.
Thank you very much, Matilda. Hi, Brad. Welcome to the HBS Alumni Club of London's event. Such incredible pulling power that you have. This is the largest audience that our club has had ever. So I'm
wow.
glad
it must be your shirt.
I'm glad that you and I dressed up for it, right? So thanks so much for that. I know on a recent podcast you said that 3 is your favorite number. So I decided I will split the next hour into 3 somewhat equal segments. First off, we'll cover your book, The Startup Community Way, and all the interesting ideas and concepts from that. Then we'll segue into angel investing and the VC world. And finally, we'll leave enough time for Q&A. Hopefully that gives our audience an interesting roadmap to be aware of. So let me start off, Brad, by asking you, the intellectual backbone of your book is complexity theory. What is it that us MBA types get right or wrong about understanding startup communities?
Well, I think it applies to MBAs, but it also applies to lots of people.
Sure.
And in this book, Ian Hathaway and I, my co-author, came up with, as the underlying framework, the idea that a startup community is a complex adaptive system. My guess is a number of people on this call probably know what a complex adaptive system or complex system is.
Yeah, maybe you can talk about it, yeah.
I was going to say, let me define it with an example, because that's the easiest way to talk about it. So think about 3 types of systems: simple system, complicated system, and a complex system. A simple system is making a cup of coffee. You put beans and water into a machine and you get coffee out. You can have different types of beans, you could have different types of machines, maybe you have milk and sugar, maybe the coffee is not very good, but it's a simple system: input, recipe, output, deterministic output. Simple system. A complicated system is doing your monthly financials. Lots more steps. You can do the steps in different sequences. You might have different kinds of things that you have to deal with. But at the end, you have an income statement, balance sheet, cash flow statement. So income statement, balance sheet, cash flow statement. I'm sure you learn that over and over again in whatever, at MIT, the first finance class is 15501. You have to learn that. I'm sure Harvard has its thing, and the professor says over and over again those 3 things until you're sick of them. And then you get financial statements from people that are just income statement, balance sheet. And you say, I can't read it because I don't have a cash flow statement. Deterministic: inputs, recipe, outputs.
Sure.
A complex system is raising a child. On the day the child is born, if you say when that child is 25 years old, she's going to have these friends, be interested in this kind of food, play this instrument, go to HBS, play this sport, where all you're doing is setting that child up for lots of therapy. Sure. We've all been children, or we have children. So essentially, raising a child is a complex system. The inputs generate outputs, which become inputs. You can't control it from the top down. There is no deterministic ending. You can't sort of deal with it in a linear way. Things happen, and language that I'll introduce from complexity theory, like phase transformations occur. The child is a certain way and then suddenly they're a different way. Or things happen, over a certain point in time and they're looking like they're on a trajectory and then they change dramatically. You have things like positive feedback loops and negative feedback loops, things that reinforce positive behavior, things that reinforce negative behavior, and on and on and on. So the key is that a startup community is a complex system. You cannot control it from the top down. It has to evolve from the bottom up. It's something that has characteristics like nonlinear behavior. Things go like this versus like this. Lots of things have to happen for a while, and then there's this rapid acceleration, and on and on and on. That is one of the big mistakes I think people have, which is this attempt, once they start thinking about a startup community, to try to organize and control it in a sense where something like a startup community is just uncontrollable.
So who are the actors who you feel control these things from a top down? Is it government policymakers? Is it universities? Is it important, influential people in an ecosystem? And what is it that they're missing about this bottom-up networked approach that you're advocating?
Well, yes to many of what you describe. In 2012, I wrote the first startup communities book, just called Startup Community. And in it, it came out of my idea that you could build a startup community in any city with at least 100,000 people anywhere in the world.
Sure.
And in it, I separated the world into two categories, leaders and feeders. And I said, in the startup community, leaders have to be entrepreneurs, feeders are everyone else, government, university, big companies, nonprofits, supporting entrepreneurship, service providers, etc. I made a mistake with that. I actually made two mistakes. One is I didn't do a good job of testing the words. So I inadvertently created a one-up, one-down relationship between leaders and feeders. I didn't mean to, they're just different. I should have called them apples and papayas. They were both important parts of the startup community, they just played different role. The other mistake I made was I didn't give voice to the people in the startup community who play leadership roles, but are not entrepreneurs. So in this book, and I came out with the second edition of the original book as well, there's now three categories: leaders, instigators, and feeders. Leaders are entrepreneurs. Instigators are people who play leadership roles in the startup community who are not entrepreneurs. And feeders are all of the organizations that participate in the startup community. Generally speaking, and not exclusively, but generally speaking, the organizations that make the top-down mistake are the feeders. Every now and then you have a person playing a leadership role who does sort of try to organize and manage everything or control everything. But that's the exception, not the rule. Most entrepreneurs and most participants in the startup community who are entrepreneurs or who are playing leadership roles that embrace this notion of startup communities get this bottom-up phenomena. Look, organizations have at their root the word organize, like that's what they do.
Right.
And a startup community doesn't have a hierarchy. It doesn't have a president and a vice president of membership and a vice president of education. It's a network. And all of the people are nodes on the network. And the interesting part of that network phenomena is not where you sit in the network. And it's also not the number of connections you have, but it's the value of the information that goes across the connections in the network, people you're connected to, multiplied by the number of connections. And this is really part of this top-down versus bottom-up phenomena.
Right.
If, for example, you're in a startup community, think of yourself as a node on the network, and you've got tons of connections to people, your Twitter followers and your LinkedIn count and your huge numbers, but you provide almost no value. And let me depersonalize it. You know of a person, and that person, though, provides almost no value in the interactions when they respond to somebody or when they tweet something out or when they show up at an event. Or they're not really providing any value in their interactions. That person's not very valuable to the network, right? Number of connections times the value of the information across those connections. If you have an incredibly insightful person, massively useful and interesting, but they're only connected to 2 or 3 people, they're not very valuable to the startup community either.
Sure.
this phenomena then evolves from the bottom up, and your power in a startup community builds based on the value of the information that travels across these connections. If you think about your value in an organization, and where most organizations, anybody that's worked for a big company, you have a hierarchy and you work your way up the hierarchy. You become more powerful that way. Well, how do you move up the hierarchy? Two ways. You either do an amazing job and get promoted, or you undermine your boss, get your boss fired, and then get a battlefield promotion into your boss's role.
Right.
I say it's sort of tongue in cheek, but that's how these feeder organizations are used to operating. And so in a lot of ways, it's not natural for them to operate in the context of how the startup community operates, but it's critical that they do if they want to be helpful to the startup community.
And in your book, when you're talking about the number of connections and the value of the information moving, you're also talking about the quality of the connections and the quality of the interactions that members of this community are having in a COVID world where, the collision of ideas, the serendipity of meeting somebody in the same hub or in the local coffee shop, et cetera, has gone away. What in your experience can be done to replicate that in a virtual environment?
There's a lot of powerful stuff going on in a really significant way. And I would suggest that it's really fun right now against the backdrop of enormous structural changes and challenges in our society and globally. So, and I use the word fun sort of tongue in cheek, right? Like it's changing a dynamic that was already changing, but it was a dynamic that was changing slowly. And I think the use of my word fun, I'll be careful with it because I don't think there's a lot of things that are fun about the moment in history that we have as a species. I think for me, it's an acceleration of something that was going on already. The acceleration, let me talk about it from that frame of reference, is I believe we've made in the last 7-8 months, we've accelerated 5 years. So many things that were happening and were going to happen over the next 5 years are happening right now. By the way, they're not all resolved. But if you think about many of the challenges around equity and structural inequities in our society that have been coming to the forefront, US is an especially visible example of this. Many of those things have accelerated. And there's a lot of focus on them in a moment. They would have continued, but they accelerated very, very quickly. If you look at things like remote work and distributed work was already happening. It was just happening at a slow pace. There was a lot of resistance, a lot of incumbent stress against it. If you look at telemedicine literally made 10 years of progress in 1 month.
Sure.
Because the worst place in the world to go, unless you have COVID, was a hospital. Right. And all doctors had their offices closed because of the shutdown. And people still got sick. They needed to see their doctors. So all of a sudden, all the incumbents, the healthcare system, insurance companies, hospitals, doctors, even patients, incumbent resistance collapsed. So we have a lot of these interesting phenomena that are going on. And to link it back to your question, specifically in startup communities, much of the thinking that I've done over the years around startup communities has definitely been place-based. And sort of this notion that the phenomena of startup communities are linked to topophilia or love of place.
Yeah.
Interestingly, the most vibrant startup communities are ones that have lots of linkages in and lots of linkages out. Right. While there's critical mass around that place, that network phenomena that includes other places is powerful. Well, all of a sudden, when you can interact with each other much more efficiently, maybe for some people with not as much high fidelity this way than you might in person, but with equal substance, and as we start to condition ourselves in different ways, we start to have more flexibility with those types of interactions. And I'll use this as an example. Chance of me doing Harvard, an HBS alumni business school event in London is close to zero. I probably go to London once a year, once every other year. And when I go to London, even if it's for work, the number of things that I'll have, this probably wouldn't sort to the top.
Right.
However, to be able to do this in an hour, and y'all can decide at the end of the hour whether this was worth an hour of your time, is very, very feasible, very simple. The other side of the equation is this only takes an hour of your time. So if it's not valuable,
Sure.
or if you're into it 30 minutes and you decide it's not valuable, you can decide not to engage with it. But if you go to a physical in-person event, you're going to be at that physical in-person event for a while. Now you're saying, well, the value of the physical in-person event is to get together with other people, not to listen to some stupid speaker.
Right.
Okay, well, are there other ways to have that kind of networking connection in a virtual world versus only getting that kind of network connection when you're physically proximate? So we're in the middle of that. I would say for many of the, I'm in the middle of it in enormous different ways around the books and the books that just came out, around Techstars, around my investing as an investor at Foundry Group, amongst all the boards I'm on and those companies, amongst several transactions, including several public market transactions. These are all things that if you had said in 2020 in January, you're going to do it all remotely from your office, from your house, not my office, from my house in Boulder, your house in Aspen, you're going to do 100% of it remotely. Or I had asserted that. The person on the other end of the phone would have said, no way, not possible. Socially, it's not possible. You're not going to be able to get deals done. You're not going to be able to make investments. You're not going to be able to manage the social dynamics of those boards. You're not going to be able, companies are not going to be able to buy and sell things. You're not going to be able to close financings. You're not going to be able to take companies public. Bullshit. Like all those things are happening. And in some ways, I think a lot of people are saying, well, why did I used to? I've been involved in a couple of IPOs where I've been one of the principals. You know, the 2 to 3 week roadshow on private planes that costs $500,000. That's completely exhausting, going from meeting to meeting in different people's offices in black cars and sitting with people that are having just people file through their office all day versus the way an IPO is getting done right now. Like,
right.
Was that actually useful? And are we ever going to actually go back to that? I hope we don't. I hope we have a transformative dynamic in terms of that type of capital raise.
Sure.
And on and on and on. There's a lot of VCs who are realizing, I can be just as effective not living in the Bay Area as I can be somewhere else, as long as when things open up, I'm able to maintain my network. And especially as networks become online, oh, wait a second, I don't have to invest only in the Bay Area if I'm focusing my energy on a broader net. How interesting. Like, we're in the midst of that kind of thought process, I think, on every dimension. And when I say, like, I'm going to change my word. I don't think it's fun. I think it's positive. I think it's fundamentally positive for our species. I think it's really uncomfortable. I think it will accelerate the democratization of entrepreneurship globally. Mm-hmm. I have as a core belief that entrepreneurship is a net positive for our society. Of course. And that around the world, anybody who wants to be an entrepreneur and wants to create a company out of nothing should be able to do it from wherever they want to do it.
Yeah.
So many of these phenomena are ones where if you think about the next sort of iterative philosophy around startup communities, it's how do you orient the topophilia or the love of place in a very powerful way around where you love to be. I love to be in Colorado, but I'm globally connected versus only being in Colorado. How can I do that without having to drag my body all over the planet all the time? Sure. And that's an interesting change that will occur with startup communities.
Right. One of the changes we're going through in the country of our host today is Brexit. And I don't mean this in a political or controversial way. You use the phrase, phase transformation. So this December, we're going through our own phase transformation. So if you were to advise the UK on what it should do to keep the startup community and ecosystem very vibrant and pulsating over here, what advice would you give to the UK government?
Well, there's probably different flavors of advice. And I also feel like I'd be presumptuous to give advice top down to governments, because I view governments as having the potential to have real positive impact on the startup community. But if you sort of know my own journey, you know that my general view is the first goal of government in the context of entrepreneurship and startup should be to do no harm. And maybe I'd start with that. I would think hard about the things that the government is doing around the phase transformation that occurs when you go from being part of the EU to not being part of the EU, and trying very, very hard not to create situations that are significant inhibitors for entrepreneurial growth, investment, and new company creation. I just start with that and sort of take it from that perspective. I'll use the US as an example of something that is substantially inhibiting the US's entrepreneurial development and growth. And is not a new phenomenon. It's been going on for the last 4 years since Trump was elected. There's some very, very good analysis of how it's actually starting to impact things because it takes some time to see the impacts. And one of the impacts has to do less with direct entrepreneurial activity, but more to do with the location of that entrepreneurial activity. The topic that I would use would be immigration, especially immigration of highly skilled workers, immigration of college students, people who want to come to the US and stay in the US. Yeah. Again, I'll try to stay non-political, like you can dig as deep into the US immigration system as you want. There's a very good New York Times article from within the last week that talks about the second order and third order effects of some of the policies and how they're really starting to take effect. One of the probably third order effects is that many tech companies have basically just said, you know what, because of COVID and because of the immigration dynamics here, we're just going to focus on scaling up our infrastructure outside the United States. Right. And so instead of hiring in the US and building lots and lots of resources in the US, none of these policies are causing us to decide to go find more US-based employees. These policies are actually causing us to scale up our international locations because many of these employees are very desirable for us to have, a cost structure that's interesting, a workflow that's interesting, and because we're going to just accept that we're a distributed organization, we're going to invest and allocate capital and resources in other geographies. So I think things like that are things that the government should think hard about, the UK government should think hard about, not inhibiting. And probably the biggest ones are going to be flow of people and flow of capital. Right. The other thing, which I think is super, super important for governments generally to think about, and I put this at a national level as well as a city level, is in the book, we separate between a startup community and an entrepreneurial ecosystem. A startup community is at the core, and there is one goal for the startup community, and that is to help entrepreneurs succeed. That's it. So when you're engaging with the startup community, your only goal is to help entrepreneurs succeed. Right. The entrepreneurial ecosystem is a superset, and all of the actors in the entrepreneurial ecosystem, which includes government and universities and large companies, one of their goals is to help entrepreneurs succeed, but they often have many other goals. Sure. An example of a misguided goal from government is to create more jobs. So economic development in government always has its goal to create more jobs in whatever the geography is. If you go into the startup community and say to entrepreneurs, hi, I'm here to help. My goal is to create more jobs. The entrepreneur looks at you and says, actually, I don't need your help. I create jobs. That's the outcome of my company being successful. Right. I need your help attracting the right kind of talent. I need your help training the right kind of workforce. I need your help providing education and resources. I need your help with a bunch of other things. And so just as the example around jobs, sure, the government approaches it from a perspective of this is what my job is versus approaching it from the perspective of what are the actions I should take to help the startup community have the successful outcomes it's trying to have. Right. So sort of link that back to that first piece.
Got it. Thanks for that, Brad. I want to switch to the topic of Silicon Valley. In the book, you talk about Silicon Valley couldn't create Silicon Valley today if it tried to. We are in an industry where we reward invention rather than replication. And yet so many people just keep talking about, we want to build a Silicon Valley in our backyard. And the implication is they want to replicate that. What do they not understand about, how Silicon Valley cannot get recreated today?
Lots of things. And I would say, fortunately, that phrase, I think, has become enough of a cliche that most people, most entrepreneurs, when they encounter it, look at it and say, okay, I get why, I get what you mean is not replicate Silicon Valley. What you mean is create a vibrant startup community. Right. I would encourage people to shift the language to create a vibrant startup community or something like that. I have a book that's title is 100 Years of Silicon Valley. And that book was written in 1994, 26 years ago.
Right.
Silicon Valley is a complex system that has evolved over many, many years. And a number of the principles from Silicon Valley are quite interesting. And many of those principles are ones that are woven throughout the theses around startup communities. They're not the only ones. And by the way, there's a number of, I would say, principles in Silicon Valley that I find uninteresting and distasteful. And I'm happy to talk about those if we want. But an example of a very powerful, positive one from Silicon Valley is entrepreneurial recycling.
Yes.
And entrepreneurial recycling is not just money, but also people and talent and experience and network. So when an entrepreneur is successful, build a successful business, they generate wealth for themselves, they generally generate wealth for their employees, they generate wealth for their investors. But their employees, their leadership team, their investors also have lots of experience. They also develop lots of network. And when those entrepreneurs reinvest all of those things, they recycle all of those things into their next company and others' next companies, really powerful things start to happen. A very sort of, it's a little tired now, but sort of coming out of the internet bubble example of that, that's gotten a lot of visibility, been written about a lot, and is a really powerful example is what people call the PayPal Mafia. Yes. And the group of people who worked at PayPal, which survived the internet bubble, became successful, went public, ultimately got bought by eBay. And the number of entrepreneurs involved that are household names that went on to invest in each other's companies, went on to help each other, went on to create new companies, went on to, with not just the founders, but the employees and next level down, continued to engage as part of that. Over a 20-year period has generated substantial success in many, many other companies, and lots of wealth. So there's a number of constructs like that. There's another really useful, positive construct to look at, which is a book that Annalise Saxenian wrote in 1994 called Regional Advantage. And it talks about the difference between Silicon Valley and Route 128 in Boston. And since everybody went to Harvard, you probably know that on Route 128, there's actually a sign, and that sign says America's Technology Highway. And that sign was from the 1970s, I think. I should probably know exactly when that sign went up. And, Massachusetts was an incredible, incredible technology startup community that evolved out of World War II, and for a while was substantially ahead of anywhere else in the world. In terms of entrepreneurial activity. The entire mini computer industry grew up there. And it disrupted the mainframe industry, much of which was based actually in Armonk, right, IBM. It then went on to build a huge software industry around mini computer companies, and the client server industry was very, very dominant in Massachusetts. There was a fair amount in the Bay Area. But the mini computer industry, Massachusetts completely missed on. And in the Bay Area, the mini computer industry, or the microcomputer industry, personal computer industry, completely disrupted the mini computer industry. And by 1994, as the beginning of the rise of the commercial internet, the dynamics were totally different. And Anna Lee walks through in her book, which is fantastic and worth reading, walks through a number of very, very specific things that were the difference and divergence between those two. So the point I would make here is there's a lot of lessons to be learned. But if the goal is to do what Silicon Valley did and recreate it, it's an impossibility, a functional impossibility, because of the way complex systems evolve. And interestingly, if you look at Silicon Valley in 2020, I would argue that Silicon Valley has many structural disadvantages over many other places in the world in the next 20 to 30 years. You know, still enormous, amazing positive characteristics about the Bay Area, still massive amounts of capital deployed there, still very significant companies being created. But if you take a long-term view, there's enormous inequities. There's huge challenges on social dimensions, and you see it day in and day out. The cost of everything is extraordinarily high relative to the value of those things. And the justification, I think, of many people to put up with the cost structure is because of the concentration and density of entrepreneurship. But when you see that phenomena shifting to other geographies, and not just other cities in the States, but other countries, you can't ignore it. And a great example on a global spectrum is China. Sure. I think 20 years ago, I think in the peak of the internet bubble, I think something like 80 or maybe even 90% of venture capital was US based. And 2/3 or 3/4 of the US based venture capital was the Bay Area, New York, and Boston. Today, globally, I think 80% of the venture capital globally, roughly the same amount that used to be in the US, is now split between the US and China. 40-40, they're roughly equal. Right. And the rest is rest of the world. And in the US, still dominated by those three geographies, but changing quickly. And also on a percentage basis, that's not even the interesting thing to look at anymore. It's the magnitude of dollars. So if you look at geographies like Seattle or Austin or New York, the magnitude of dollars are so much higher than they used to be. So even though the percentages may not have moved that much, you're seeing very significant capital investment in other places. And one knows that 20 years later, like wind that clock 20 years forward from there. Sure. Last comment I'd make is one of the things that I think is really important about building a startup community is focusing on your strengths and allowing your strengths to be the things you build on. Silicon Valley has strengths, Silicon Valley has weaknesses. Sure. And those strengths and weaknesses are not just about financial capital. And in Startup Community Way, we talk about the seven capitals that include things like intellectual capital, infrastructure capital, network capital, cultural capital. Financial capital is money, right? But it's not the only type of capital. So when you start looking at those things and you think, okay, well, we're in London. What are the reasons we're here in London? What are the strengths of London as a city on the global scale? And what can we do more of? And this comes back to the question about government. What can we do more of that causes London and England broadly, but London specifically, to be a really interesting place for not just entrepreneurs to come because of financial capital or even network capital, but for other reasons? And what are those other reasons that then create positive feedback loops that play out over a long period of time? And look for that as part of the motion versus, well, we need one of these and we need one of these and we need one of these.
We hope that the next time you visit Europe and the UK, this whole healthy, virtuous cycle of entrepreneurial recycling would be in full flow, and you can see it, firsthand. So one of the things you talked about was entrepreneurs who have had exits, or people who've worked at companies and have made a little bit of coin on the back of the exits of their companies can reinvest that and act as mentors and angels in other companies and the successive generations. If someone has to start angel investing from fresh, what advice would you have for them? Should they be specialists? Should they be generalists? What kind of behavioral attitude should they display? Perhaps you could talk a little bit about that. We've got a lot of angel investors on the call today.
I'm going to toss up a blog post, which I'll, it's always so much easier to put up a blog post when I'm not on Zoom. I wrote a post. No, I'll put it up. I wrote a post in 2010.
Yeah, that's the suggestions for angel investors post. We talked about that. Yeah.
Correct. So here's the post for people who want it. Oh, I put in the panelist link. See, again, Zoom doesn't anticipate. Its AI is not anticipating what I want to do yet.
Right.
So read it later, but that's, I won't answer it with that. But I wrote that in 2010. I read it recently because somebody else asked me about it, and it felt very relevant. So here's a phenomenon around angel investing. I'm going to describe my own story.
Sure.
Because that's how I became an investor. So I sold a company in 1993. It was a Boston-based company. It was very creatively named Feld Technologies. Don't ever name your company after yourself, because when things get all screwed up, they call for Mr. Feld. Like, that's not. When my partner's name was Dave Joke, and when he screwed something up, they called for Mr. Feld. It's a good successful company. Sold it to a public company. Made a couple $1 million. And I decided that I would take all the money, except for, I told my wife, Amy, we always have $100,000 in the bank. I take the rest of the money. We bought a house. The rest of it, I was going to make investments. I was going to start companies, make investments. I knew nothing about investing in a company. In fact, my first company didn't have a lawyer. We did all of our contracts on just sort of plain English, one-page things. Very simple contracts. And when we sold the company, we hired a lawyer. We had no corporate records over the previous 7 years, nothing, no formalism, other than we incorporated the company with the corporation, which was a company for $99. You can incorporate your company. I mean, really just no sense of how to do any of this stuff. And I just started making angel investments with a couple of friends who also hadn't made angel investments before, with the two guys that bought my first company, who had a little bit of experience, a lot of experience buying companies, some experience investing in startups, and then just with others as it sort of came about. Over a 3-year period, I invested in 40 companies, $25,000 to $50,000 at a time. So same size check, roughly. Sometimes I doubled down on the check I wrote. When I first made my very first investment, it was a company called NetGenesis. I effectively was a co-founder of it. This was in 1994. I became chairman. I worked with the founders, and essentially just figured it out as I went. And I did it with a friend of mine, a guy named Will Herman, who was a successful entrepreneur. And on we went, right, in terms of just these investments. Those 40 investments, 3 of them ended up being worth more than 100 times the check I invested.
Right.
So the other 37 investments could be worth 0. And I still tripled my money.
Sure.
Right? So more than tripled my money. So one of the lessons is you have to actually make a reasonable number of investments. As an angel investor, you're not trying to pick the one that's right. You're trying to pick ones that you have some reason to invest in them. But you're trying to invest in enough. Number 2, over a period of time. So I invested 94, 95, 96. Now my timing was good in hindsight because it was the rise of the commercial internet. But I had no idea my timing was going to be good. My timing could have just as easily been terrible.
Right.
And I've learned that lesson over and over again, which is you invest very consistently over a long period of time. Figure out a strategy and a pacing, and then execute on that strategy and pacing. Next, for me, when I started investing, I focused on 2 things: people and product. That was it. Did I have an affinity for the product? Did I want to be partners with these people? Today, having made, I don't know how many hundreds of investments, I would tell you that most of my investing strategy is the same.
Right.
Do I have an affinity for this product? I don't have to be a daily user of it, but do I care about it?
Yeah.
And do I want to be partners with these people? And do they want to be partners with me? There's
Right.
plenty of other stuff to think about as an angel investor, but those are really the 2.
Sure.
I would say most of the decisions, those 3 companies that I talked about that were worth 100 times my money or more, I think I made all 3 of those decisions to invest in the first or second meeting. Right? There wasn't long deal. These were brand new companies. I had no idea what I was doing. They were just things to try. An example that I give of that, I don't know if people know the company, remember the company Harmonix, Boston-based company. They made Guitar Hero and then Rock Band, got bought by Viacom, then made Dance Central, got spun out again by Viacom, and now are doing VR games. I like to say it was, a classic overnight success. I invested in 1994. I helped put together, I think around they raised maybe $100,000 from their family. I helped put together a $500,000 round, of which I put in $25,000 or $50,000. I can't remember now. I think $25,000. A bunch of my friends did. My dad did. Some others did. They tried to go out of business every year for a decade and managed not to.
Right.
I don't know if people are fans of Hitchhiker's Guide to the Galaxy, but there's a character named Zaphod Beeblebrox who was president of the universe. And Zaphod's a distasteful character, but enormously amusing. And he describes how to fly. He says, the way you fly is you throw yourself at the ground as hard as you can and miss. This company tried to go out of business every year and managed not to. And then they came out with Guitar Hero 11 years after they started the company, and multi-billion dollar. Ultimately, I think not multi-billion dollar exit, the ultimate exit with earnout and everything was $750 million, something like that. But they only raised $10 million, and for an investor, it was something like a 200x on the money. So the point of that is, as an angel investor, find products that you're interested in, find entrepreneurs you want to work with, be an angel, not a devil. Your job is to help. You're investing at the very beginning. So, you're making a judgment that's not based on a bunch of analysis. You're making a judgment based on, do you like the people? Do you like the product? Do you want to be partners with them? And you're going to have a lot of zeros. A lot of things are going to fail. Those 40 companies, 20 of them were zeros. If you had asked me the day I closed each of the 40 investments, you said, which one are going to be winners and which ones are going to be zeros? I couldn't have told you. I've never known an investor to say, I thought this was an awful company. I hated the founders. This was a terrible idea, but I put money in anyway. That's not what, there's not, you might think, the idea could be better. You might think, we need to add some people to the team. But everything you invest in, you think is going to be successful, but you have to have a strategy versus you're trying to pick that one.
And along with the strategy, Brad, would you advise angels to be aware of their own behavioral side? I know there's a lot of talk in the public markets about the behavioral side of investing. Given that in the private markets, your losses are coming early, and like you said, for Guitar Hero, it was 7 to 10 years before, they had that breakaway product. How do you know you're good at this? And how do you keep, your mental stability around, I've been putting in $25,000 checks for 10 companies every year. I don't know when my ship's coming in.
It's a super important question. So here's how I did it in that time period, because I had no idea whether I was any good at it or not.
Right.
Remember, I told Amy that I would never have less than 100%, or sorry, $100,000 in the bank. By the way, I do remember having to tell her that we had less than $100,000 in the bank because, I hadn't had returns, and I just had one more thing I wanted to do. I probably should, let's say the number of investments, the dollar amount of the investments was around $1 million. It was a little bit more than $1 million, but let's say it was around $1 million. I had decided that I was going to lose. I decided it was okay to lose $1 million. Now my net worth was, let's say, $1.5 million, right? But I decided it was okay to lose $1 million, to have that $1 million go to zero, because between the house I had and my earning power, and $100,000 in the bank, I never thought, I'd be fine. And so my view was, I'll lose, I'm comfortable losing $1 million. Now, of course, that $1 million turned into a lot more than $1 million. And it happened, when it started to happen, it happened quickly. I had invested all of my own money that I was going to invest before I had any meaningful exits. I did start to have a few. So I had a few exits come back. I got $100,000 back on something, and maybe I had another, six-figure exit, but low six-figure exit on something else. And I had a few things where I invested $25,000 and the thing didn't work, but somebody bought it and I got $15,000 back, and I had some zeros. And by the time I had actually stopped investing, by the time the big investments started to come back as an angel, because I started working with I co-founded a venture firm that ultimately became called Mobius Venture Capital in 1997. I started working with SoftBank in 1996, and we spun this firm out, SoftBank Technology Ventures, which eventually became Mobius Venture Capital.
Sure.
And so from kind of 97 onward, I was not making any real angel investments anymore because now everything was going through the funds.
Right.
And in 1997 and 1998, I had a number of exits, a couple of sales, and a couple of IPOs. And I remember one exit, and the exit value, not what I realized in the end because of the internet bubble crash, but the exit value, my share of the exit was over $10 million. And by the way, again, what I got out of that deal was much less than $10 million because I held the stock and sold some of it, but didn't sell all of it. And I had one company that I co-founded in 2000. My stake was worth about $100 million personally. It went bankrupt in 2002. So a lot of very significant and powerful lessons on the downside of the internet bubble as well. But it's one of those things where the money compounds pretty quickly. And if you're comfortable losing all the money, then you don't start doubting yourself and you sort of stay with the strategy. And by the way, I've had phases of angel investing where my angel investing, I look at as sort of a time, and venture investing, I look at a time period and like, wow, the 5 companies in a row that I did, all 5 of those failed. So, they failed for different reasons. That one failed because of timing. That one failed because of execution. That one failed because it turned out to be a shitty idea. That one failed because it was the 17th one of those, and the only ones that had any economic value were the first 3.
Right.
On and on and on, right? So it's not that like you get good and all of a sudden everything works. You keep making lots and lots of mistakes.
Right.
And so I think if I had stayed an angel investor and not been a venture investor, I probably had enough money from some of those early exits and from the things that I was doing that generated cash flow to kind of keep investing. I was investing about one company a month. And even at that point, I went under $100,000. And then I said, Amy, but don't worry, we have an exit coming. And then we had one of those exits, and I got, maybe I don't remember the numbers, but let's say I got back up to $250,000 in the bank, not having paid taxes yet on the exit. And I probably would have been able to stay on that pace indefinitely. The mistake I would have made is if I had accelerated that pace. And all of a sudden, when I had some more money going into the teeth of the collapse, instead of investing, $25,000 or $50,000 a company, I started investing $100,000 or $250,000 a company. And instead of doing a deal a month, I started doing 3 deals a month. So it's, again, having a strategy and staying with that for a long period of time, I think is so much more valuable than either trying to pick a thing or starting to accelerate, for example, as the markets get higher.
Right. And that's why I asked about the behavioral side of things. We'll switch to some audience questions now. There's a question from Marcus on how would you approach startup communities in nation states or regions that have become complacent due to dominating industries, for example, oil and gas?
Well, the nation states discussion is a loaded one, partly because, and I say loaded, not bad loaded, interesting. I have some experience with a couple of, I would say, Middle Eastern countries that are very historical economies, oil and gas centric, that have been very, very focused on diversifying their economies through entrepreneurship. And my general sense is that an increasing number of nations, countries around the world that are constrained historically around singular industries, and oil and gas kind of is the easy one for me to process. I grew up in Texas too, so I understand the dynamics of that from Texas.
Right.
Is one where I have seen in the last 5 years much more attention to this. I would say it is very, very challenging because you have both top-down government dynamics where these countries have massive dollars that they're allocating a certain way to try to generate entrepreneurial activity. And oftentimes that collides with the bottom-up activity. of entrepreneurs and of the startup community. I'm seeing much more, I would say almost enlightenment around that in some of these places because of the recognition of trying to do more things rather than trying to do the right thing. And I think this is what I would encourage people to think about, which is essentially a startup is a series of experiments. You do lots of experiments, many of them fail. The ones that work, you do more of. The ones that fail, you learn from and iterate on. And if you are a student of Steve Blank and then Eric Ries's work, customer-led development or customer-driven development and now lean startup, you understand that innately. If you're not familiar with that, Eric Ries does a nice job of writing the foreword for the Startup Community Way. I was really pleased when I asked him to do it, that he was willing to do it. Yeah. I also asked him, by the way, if he was okay with the title, because his first book was The Lean Startup and his second book was The Startup Way. Yeah. And I really wanted to, sort of riff off that because many of the underlying characteristics of a startup community are analogous, different, but analogous to the underlying characteristics of building a startup. And Eric's a longtime friend and has been very helpful intellectually to me over the years, as well as from a friend perspective. And this is the key, right? Like you look at those countries and you say to those countries, look, you gotta combine the bottom-up activity with the top-down activity. You're gonna have to drive that as entrepreneurs. You're not going to be able to get the government to understand that. But if you keep saying and doing that over and over again as entrepreneurs, they start to collide and then they start to work together over time.
There's a related question, Brad, on why do you think Israel's been able to develop such a vibrant entrepreneurial ecosystem despite its geopolitical challenges? Is it something the government did there top down, or was it, in your experience, again, Startup Nation being born from the ground up?
Well, there's a magnificent book about this story called Startup Nation. I've lost the authors in my mind. We definitely refer to it. I've read it several times. Yeah. And there's a long history here. And I would probably characterize three key things. Number one, there was real government focus on deploying capital through funds into startups. And I think the time frame was in the 1970s, right? That's right. Dan Sonora. And that program, while it was relatively small in terms of dollars, was very, very effectively executed. Second, there became a number of very wealthy entrepreneurs in Israel who embraced entrepreneurial recycling.
Sure.
And that was very significant in the security industry. And then that evolved and grew as it expanded into the commercial internet. So in the early 1990s, pre-commercial internet, Israel was probably the best source of security companies in the world other than the US.
Sure.
Third, actually there's probably more than three things. Third, there's a huge culture of entrepreneurship around all aspects of the country, right? Israel itself, as a country that was started in 1948, is itself an entrepreneurial endeavor. Right. And it's an entrepreneurial endeavor with enormous conflict and enormous pressure and enormous challenges around it, especially given the natural resources and the dynamics around the natural resources. And so education as a core value of the country. I think the discipline generated by a military service, the topophilia, love of a place, right, and the desire of people in Israel. I have a number of friends who are American Israelis. I'm an investor in several companies over the years in the US that have founders who grew up or were in Israel as children for some period of time. Several of them came to the US relatively young, but several of them came for college. And it's remarkable the power of the linkages and the network amongst all the people. And so I think you look at these things and you say, well, does that happen quickly? And the answer is no, right? I mean, that is a phenomenon that has been going on in the country for a long time. And so the idea of entrepreneurship appearing overnight, why is the security industry, one that has its roots, computer security having its roots in Israel or having such powerful generative sources? Well, because of the stress of the military and the pressure of the country and the amount of investment people made while in the military or while in government service or around it,
right.
And the strengths of that. So those are the kinds of phenomena. It does come back, by the way, to that comment we made earlier about the 7 capitals. Like, what are your capitals? What are those natural resources that you have in your geography that you can build on, combined with topophilia, love of place,
sure.
And a very long-term view, right? This didn't happen in the last 5 years. This happened in the last 50 years, last 75 years.
Sure. Brad, there's a couple of quick questions on the name of the book that you wrote in 1994, 100 Years of Silicon Valley. Somebody.
So I didn't write the book. It's a book I read.
Okay.
But it's called 100 Years of Silicon Valley, and Kartik afterwards, if you want, I'll try to get the links to you and you can get them out to this group.
And the other question is on the book that you read that you reference in your book, comparing Route 128 in Silicon Valley about the regional differences in ecosystems. Somebody wants to know the name of that book too. I actually have your book with me, so I can look that answer up while I ask you the next question. It's from Eric Vanderclyde. He says that he invited you to number 10 Downing Street to feed into policy thinking around an accelerating and thriving entrepreneurial ecosystem for the UK. So today, in a COVID work from home world, how do you ensure that the feedstock of startups created by the serendipity of meetups, hackathons, networking, social brainstorming continues? What would you do?
Eric, nice to hear your name again. I remember that day well. There's a funny story from that I can tell very quickly, which is not knowing any better because I wasn't really paying much attention. As we were leaving, I started taking pictures from within 10 Downing. So you see all these pictures of 10 Downing, the doorway. I took one of those pictures. But as we were leaving, I took a picture of the gate and the guards and all the people outside the gate. And very nicely, one of the guards with a very big machine gun came up to me and politely, with his very big machine gun, asked me for my phone and said to me very politely, of course, the guy with the machine gun comes up to you, ask you for your phone, you give it to him. He said very politely, you can't take a picture that direction for security reasons. And that moment, like what have I done wrong? Like that terrifying moment. And then he smiled at me and we had a chuckle. I would say that the phenomena that's happening, and this is a good example of it, is right now, I think many organizations are doing a pretty good job dealing with remote and distributed everything and making that remote and distributed layer more interesting as they iterate through them. And I think ultimately, for the phenomena that was very place-based phenomena like hackathons or like accelerators that were really at the root of very early stage entrepreneurial activity, I feel like that's starting to meaningfully improve. The first wave of it, as everybody was adjusting to COVID, I would say was fairly static. The technologies needed to evolve a little bit, not a lot, but mostly we just had to get used to it and get used to working with it and understand how to work with it better. I would say I've been involved personally in a number of events. Kartik found the book, Regional Advantage, while we're talking, that's exactly the book. I've been involved in a number of events, both Zoom-based and with some other platforms, where I would say that they're doing a reasonably good simulation for a day of an in-person event, but in some ways they have a lot more flexibility because they allow people to come in and out of the events. They allow people to really engage when they're interested and disengage when they're not interested. And the best ones have continuity beyond the event. Today, I don't know that we'll have any continuity beyond the event. My email address is easy to find on the web, brad@feld.com. Kartik knows me, so presumably if there's other things, people can reach out to me. But sort of the group connectiveness, I think, is the next layer. And I think over the next 24 months, there's going to be huge amounts of activity around all of these things not just in a single geography, but in many geographies. And I'd encourage everybody, not that I have the right answers, but that I'd encourage everybody to experiment with things.
Thanks, Brad. Do you have another couple of minutes for a couple of more questions, or?
We can hang out for 2 more minutes. I have a thing at the bottom of the hour, but since that ran over, let's just do.
Got it. So in which case, what 1 or 2 pieces of advice do you have for all our attendees of, you know, even small atomic things they could do in their local communities to have an outsized impact where they live to promote entrepreneurship?
I'm gonna give a very simple cliche answer. Just get involved and make a lot of noise. Talk about it, write about it, blog about it, engage with others about it, make investments as angel investors when you can, talk about what you do, be public. There's a whole section in the startup community way around storytelling. And I have a blog post tomorrow that's a great example of this. If you go to feld.com tomorrow, you'll see it. And it's a specific thing I'm doing in Kansas City around their startup community. And I think it's just this case of don't ask for permission, just do stuff. And know that some of the stuff that you do, nobody's going to pay any attention or respond to, but some of the stuff you're going to do is going to land and be very powerful and very strong. And that's the trick. Again, run experiments, just try things. If they don't work, learn. Great. And try something new. If they do work, do more of it.
Excellent. Well, that's great advice. We at the Alumni Club here in London are very happy to make some noise about your book over here.
Thank you.
If you haven't come across it, folks, do read it. You'll really find a lot of signal on every page. Brad, on behalf of the club here in London, thank you very much for your time. We wish you a healthy rest of 2020, and to all the members of our audience, stay healthy. Your startup community needs you. Thank you very much. All the best.
Good to see you. Thanks, everybody. Good luck with things and be healthy and safe.